Well, I make that just past 3 o'clock UK time, so we'll commence the webinar now. And that'll lead me to start by just saying welcome everybody to the third and final Block Asset Management webinar of the year. Most of you will know me. I'm Kevin Ballard. I'm co-founder of Block Asset Management, and I'll be co-hosting today's webinar along with Block Asset Management CSO, Daniel Vega Dominguez. Do you want to say hi, Danny? Give us a wave.
Yes, hello everybody. Happy to participate in this webinar. I joined from the beginning with Kevin and Manuel and a partner. We are very happy and thank you for the participants, especially Richard. It's very late for you. So thank you everybody.
Excellent. So just a brief few words on Block Asset Management for those of you that do not know. Block Asset Management are creators and managers of the world's first digital assets focused fund of funds. We are an AIFM registered with the regulator in Luxembourg, so a specialist digital assets AIFM, and we were the first to be registered with the regulator in Luxembourg for that capacity. We provide entry to the digital asset space by investing in a diverse basket of best-in-class managers with the aim of reducing or removing the unnecessary risks and reducing volatility. We do so by investing in, as I said, a diverse basket of currencies, digital assets, and managers, and also by carrying out what we like to think of as one of the strictest institutional grade due diligence processes in this sector. And of course, we have an active fund management approach. Today, we're very happy to be joined by 3 of such best-in-class managers that I just spoke about, so underlying managers that we have allocations to. And this gives me a moment just to introduce the 3, or ask the 3 panelists just to introduce themselves. So if I can start with Jeff, if you just introduce yourself and your fund.
Hello, everyone. Jeff Dorman, Chief Investment Officer and co-founder of ARCA, which is a Los Angeles and New York-based asset management firm dedicated to digital assets. We have several fund strategies, with our flagship fund being the ARCA Digital Assets Fund, which is a long-biased, research-based directional fund investing in tokens, as well as our digital yield fund, which is aiming for 10 to 20% annualized returns.
Thank you very much, Jeff. And Brian, over to you.
Sure. So I'm Brian Kelly. I run BKCM, digital asset firm. We have a couple cryptocurrency funds. We're a crypto fund shop. We have our master fund, which is an actively managed fund of about 30 to 50 different cryptocurrencies. And we have a dedicated DeFi fund as well. And have known Manny and Kevin for quite a long time. So exciting to see what's going on with Block Asset.
Thanks, Brian. And lastly, but by no means least, Richard, all the way from Australia. Richard, if you'd just like to introduce yourself and your fund.
Thanks, Kevin. It's Richard Galvin. I'm the co-founder and CEO of Digital Asset Capital Management. We're 100% focused digital asset manager of institutional and family office money through this space. We started the business in 2017 and we run 3 funds. Today we run a venture capital fund, a long-only fund, which is digital asset fund, and a market neutral income generating fund called DAF Greeks Fund. We take a very fundamental approach to the space, research driven, focus on the space with both the technical and a commercial overlay to the research and the way we select opportunities.
Excellent. Thank you very much, gentlemen. I'm sure the audience will agree it's a very diverse set of asset managers that we have with us today. And I do reiterate, best in class, because all have indeed passed our very stringent due diligence process. And before we go into the questions, I'll just state that there is a tab below for any questions to be submitted. So if we get time at the end, we will run through those questions, but we won't be answering questions that relate specifically to questions on meme tokens. So if you've got questions around Dodge or Sheep or Flocky, then please just keep them to yourself for now. Okay, let's fire away. First question, I guess, will lead around the fact that it's been quite a year for the digital asset space. We are clearly amidst a bull market, and many digital assets have reached record highs either this month or last month. I guess the question is to the audience, what factors are driving the bullish market conditions? And I guess I'll put that across to Jeff if I open the question to you first.
Sure. So, I mean, starting at the top from a macro standpoint, this is as good of a quadrant as you'll find for risk assets. When we talk about, different quadrants, we're basically have been in an inflationary boom quadrant right now, right? Where you have inflation modestly moving higher, but, obviously people differ on this, but it's not out of control, right? We're coming off of very weak year-over-year comps because we were in a depression last year. But if you look at 2 year over 2 year, the inflation has been moderate in line with what central banks have been gunning for. And you've had, massive GDP growth, right? That is a boon to risk assets. And you're seeing it in equities, you're seeing it in digital assets, and, you're seeing it in real estate and other places. From a bottoms up standpoint, it hasn't been a clean sweep for all digital assets. It really has been quite a bit of sector dispersion. So, you've seen cryptocurrencies and DeFi largely lag, and you've seen new up and coming sectors really start to grow. You've seen smart contract platforms. It's been Ethereum only for the last 4 years. You're starting to see real build outs on Solana and Avalanche and Terra Luna. We've seen massive growth from Web3 and gaming and NFTs. So, as much as the media likes to paint this as cryptocurrencies and just one, large digital asset market, the reality is it's completely different ecosystems that all just happen to be packaged within digital assets, and certain areas are doing better than others. No different than, how we would describe ETFs, right? Some ETFs that are involved in equities are doing better than ETFs that are involved in gold. And that's what we're seeing as this industry continues to evolve and mature.
Excellent. Thank you very much. Brian, do you have anything to add?
No, yeah, I think, what Jeff mentioned about the dispersion in the asset class, what we've seen, I've been in this since 2013. We started the fund in 2017, and this is really the first year that you've seen that dispersion among sectors within cryptocurrency. So if you think about Bitcoin as your kind of S&P 500 index, if you will, and what drives that, that is certainly driven by the macro environment. It's driven by institutional adoption. And Bitcoin has clearly become this macro asset. That being said, you are starting to see other sectors trade outside of Bitcoin, which is what we need. We need that breadth in the market for these things to stop trading like one big monolith. Bitcoin goes up, everything else goes up, and start to trade on the merits of the projects and the network effect of each of these individual ones. So yes, we have a great macro tailwind. The ultimate question for everybody, and I know we're going to get to it, is when does that macro tailwind end? And if it does, what does it mean for Bitcoin and what does it mean for altcoins, if you will? And I think the encouraging part is what we're seeing now is that altcoins are trading on their own. So you don't necessarily need to have a Bitcoin price 10 times higher than it is today for different sectors within cryptocurrencies to outperform.
Excellent. So Richard, do you have any comments as well?
Yeah, no, I agree with the comments so far around the macro environment just being conducive, particularly for risk and growth assets. But I think that's where that's the only point I'd add around the focus around growth. There is real fundamental underlying growth in this space at a user level, at a revenue level, at an adoption level. And I think whilst, the asset class is obviously, as you mentioned, reaching new highs, there's reasons for that. It's not just completely speculative driven. There's actual user growth and fundamentals underlying that growth, which makes us much more comfortable about this growth than we may have been 4 or 5 years ago.
So, well, that leads me nicely on to the next question, which then really covers the areas or the verticals that you think offer the best opportunity for those looking to get into the market right now. I think if we start with you, Richard, on this one and go reverse.
Yeah, we think the incredible growth in the space across both the application layer and the protocol layer over the last few years has created an opportunity, I guess, for what I'd say is that integration or infrastructure layer of the space. We're a big believer that we're in that, to use the internet analogy, we're in that kind of dial up to broadband type crossover in the space where we go from the millions of users to the billions of users. And to get there, we need to abstract away some of the concerns or some of the hurdles that stop new users or less familiar users entering the space and using the applications that have been developed. And a key part of that is bringing the infrastructure together, bringing these different layers together, these different applications together, abstract away some of the issues or the hard parts around using them, make the user experience more integrated, more seamless. And so we've spent a lot of time over the last 12 to 18 months focusing on the projects that are working on that, making this space that much more accessible as we scale from those millions to billions of users.
Excellent. Brian?
You know, as I look forward, I think there's a lot of areas that could be really disruptive. We are obviously very focused on DeFi, despite, you know, it has kind of gone sideways, DeFi in general. You know, but to Kevin's point, if you're looking at, I'm sorry, Kevin, to Rich's point, if you're looking at the growth in these underlying sectors, I think DeFi has as good of a chance. You look at, you know, simple metrics like total value locked and those type of things, and those are starting to hit new highs where prices maybe not have hit new highs in DeFi. So I certainly think that is a big sector. We happen to have a view that, you know, DeFi is going to disrupt a huge portion of financial services. And if you think about valuations of what financial services are versus what kind of DeFi coins and DeFi cryptocurrencies are, there's just a massive difference between those. So that to us is where a really big opportunity is. You know, the attention's turned to the metaverse because Facebook decided to change the name. Metaverse has been around for a while, and cryptocurrencies have been in the metaverse for a long time. So we're looking at opportunities in that as well. And then of course there's NFTs, which everybody loves because they went straight up. You know, I personally am a bit skeptical about why a particular animal might be worth X amount of dollars. But I do see the promise of NFTs. You know, I've always said someday what you're going to wake up and Nike's going to be selling digital Air Jordans that, you know, only 11 people in the world can buy. They're NFTs and you can wear them in the metaverse or any one of your games. That's the path we're on. We're not there today, but to me, that's the promise of NFTs.
Brilliant. Just one question on that before I just pass over to Jeff, is with regards to the total value locked in, I'm personally seeing that it's a measurement that I look at regularly, and we look at on a fortnightly or monthly basis, and I see varying balances being recorded. So one I think I look at is DeFi Llama, another one might be DeFi Pulse. There are various different tools you can use to go in and have a look at various websites. The disparity in that is ranging between 150 billion locked in and 250. Where do you see is the actual amount now? Because I'm seeing a range between 150 and 250. Do you know the figures at the moment of what the total value is?
Yes. So a little bit of that distortion and a little bit of the the criticism of total value locked is that it doesn't on the surface it includes the increase in price of all the tokens and all the price and the tokens of and the Ethereum token. So you know that in and of itself you might say, hey, wait a second. You know, maybe total value lock hasn't increased and Ethereum has just increased, and that's really what we're seeing. So it's not a perfect indicator. To me, really what we're looking at in all of these assets is network effect. So if I see that total value locked, then the absolute value is really less important to me than the directional that it's going. And what we're seeing is, you know, new time high, new highs. So that's important to me, whether it's 150 billion or 250 billion. As long as either one of those figures are growing, I'm a happy guy, and it seems to me that the network is growing. The network effect is growing.
Excellent. And then Jeff, again, just to remind you there, so we're looking at which verticals do you think offer the best opportunity for those looking to invest in the market right now? What are your thoughts?
Sure. So we've been, some of the themes that we've been investing out of for the last year and a half really haven't changed, right? We still believe that the growth of decentralized finance is going to be huge. It's just happening in different sub-verticals now of DeFi, right? Where I think asset management within DeFi is not particularly interesting, but I think lending and borrowing, decentralized exchanges and structured products really is. So like most of these different sectors of the digital asset economy now, you're starting to see some differentiation and some specialization in areas that will really grow. Gaming and NFTs has been something we've been investing out of for several years as well. We're continuing to make investments there. It's the most natural use of blockchain today. It's also the best on-ramp that we've seen outside of Bitcoin really ever. You know, 3 years ago, everybody entered the digital asset space through Bitcoin. Now it's not uncommon, and in fact, it's actually frequent that investors will come in through a different lens besides Bitcoin. They'll come in through playing a game. They'll come in through NFTs. This direct-to-consumer on-ramp is a huge way to get adoption and to do what Brian said, get from the millions of users to ultimately the billions of users. Where else we're looking, though, is we're really big into consumer applications right now. As Brian was alluding to with TVL, when Ethereum got to about $25 billion of market cap, they had about 10 billion of TVL. And from there, the applications that were built on Ethereum had outperformed over 7x relative to Ethereum. So the first real applications were DeFi. The next applications were gaming and NFTs. If you had stopped investing in Ethereum right around 10 billion TVL and invested in all these applications built on Ethereum, in aggregate, you would have done incredibly well. We're at that same point now on Solana, Terra Luna, Avalanche, and some of these others where the market caps are in the 50 to 70 billion range, even though TVL is still at that $10 billion range, which means that you need a few killer apps here eventually for the protocols themselves to be sustainable. So we often call the protocols kind of a lazy man ETF or a lazy man index because it's an all-encompassing way to play the growth of this asset class, but it's not sustainable on its own. You need to actually see real traction. So finding those areas of real traction, it's going to come with some sort of an application. So Solana to date has largely just tried to mimic what Ethereum has done, but do it in a faster, cheaper way. But you have other chains right now that are trying to be more specific to other areas. So for instance, Terra Luna is built specifically around the growth of the UST stablecoin, which is an algorithmic stablecoin. If you're a believer in digital money and you're a believer of this idea of having non-sovereignty behind your money, Terra Luna could be incredibly interesting. Just for an example. So we're looking at which chains right now are offering applications that can do things in the traditional world direct to consumer. So, you're looking at certain applications like a Helium or like an Akash or like a Unibright. These are areas that we're looking to that we think will have nothing to do with decentralization or nothing to do necessarily with technology and more to do with can we get these products in the hands of everyday consumers where eventually they don't even know they're using the blockchain?
Good answer. Now, I think Brian was almost going to touch on this earlier on, and I guess it's the $1 million question. So how much longer can the bull run last? I mean, there's talk of a super cycle that's been mentioned quite widely online, and anyone who follows many of the analysts online, obviously some much better than others. Also, famed crypto analyst Willy Woo recently said that he believes the 4-year cycle is dead. I'm just wondering what your thoughts are on the current market ending. When do you see the market topping out? I know it's a tough one, but we'll if we put this to Richard.
Yeah, I think you've got to look at that with two lenses. Clearly the macro environment is important, and I wouldn't profess that our space can continue to perform strongly if the equity markets collapse, for example, or go through a significant patch of weakness. So there needs to be a macro overlay there, and that's partly, as we mentioned in the first question, partly the reason the space has done well over the last 18 months or so is there has been a conducive macro backdrop for our space to prosper within. Looking at it more specifically, investors pay for growth. I mean, it's a simple formula that's worked decade over decade, across different subsectors or whatever type of investments you want to make in growth-focused equities, that people pay for growth. So as long as the space continues to innovate, as long as it starts to come up with new applications, starts to develop new ways to attract new users, it'll continue to attract new capital as growth drives that attraction of capital. And we've seen that over the last 12 months or so with basically the tsunami of growth that the NFT boom has brought to the space. I mean, you can query about how real some of these tokens are or the actual value of them, but it's undeniable that they are attracting those millions of users to the space that haven't had any interaction with a blockchain before. And that's the kind of adoption metrics you need, and that's the kind of adoption that keeps driving the underlying growth of the service providers to those NFTs, the chains that are delivering those NFTs to the users. And it's the sort of thing that keeps pushing that growth at a fundamental level as opposed to just a speculative repricing level.
Excellent. Brian?
Yeah, this is the question that everybody wants an answer to, and
Good one as well.
I mean, listen, if we did not have the macro backdrop that we have today, one would expect 2 years after the happening is probably where most of the gains, that 2 years right after is where you get all the gains. So you'd say, hey, we're a little bit long on the tooth. I do think the big difference this time is the macro environment and the investors that are in Bitcoin. I'm going to talk Bitcoin specifically because that is a macro asset. Those investors are not necessarily looking at the cycles. They may be, but they're really, their investment thesis is, hey, listen, this is going to be something that displaces gold, and I'm already using it to displace gold in my macro portfolio. So, as I look forward, we will need some kind of a macro shock to keep those investors in. If inflation gets under control, if central banks decide that they are going to raise rates and we get positive real interest rates, that'll probably hurt Bitcoin. But I don't think that we're going to have one of those 70 or 80% crypto winters that we've had in the past. I think it would be shallow. And the reason for that is you do have plenty of people that are playing this outside of the cycles. You also have more sophisticated players in here. You can be long and short, so there's support and resistance on both sides of the market. And I happen to have a macro view that even if we have some kind of pause in central bank money printing, we have the most debt that we've ever had in the history of the world, and that implies collateral prices underlying that debt have to remain strong. So any type of central bank pulling back on the economy that has assets price fall, to me, is going to be met with more money printing, which is just crazy bullish for Bitcoin. So even if we get, let's call it a 40% pullback at some point in time, that lasts 3 to 6 months or so, which is kind of my base case at this point in time, you start to see central banks print money again. That's going to be the buying opportunity of a lifetime.
Very thorough. Thank you very much, Brian. Jeff?
Yeah, I don't believe in a lot of the things people say about the digital asset market. Things like Bitcoin dominance, even the word cryptocurrency alone. These are terms that are completely outdated. The idea of an alt market, I mean, these are just outdated, foolish terms that should have been, abolished 4 years ago. So same thing with the idea of a super cycle. I mean, these are completely different assets, right? You would never say, are we in a super cycle for ETFs? Because it would make no sense. Every ETF is different. You would not expect a healthcare ETF to trade the exact same way as a government bond ETF, and you wouldn't expect that to trade the same way as, a gold ETF. So, I'm looking at Bitcoin's up, what, 100% this year? I mean, half the equity market's up 100% this year. I wouldn't call that a super cycle. If you're looking at certain protocols like Solana and Terra Luna and Avalanche, yeah, those are overheated. I wouldn't buy any of those right now. But gaming and NFT, these are unique, different assets. If you buy the right ones at the right time, certain assets will do well and others won't. For example, I wouldn't buy Illuvium at a $10 billion valuation when the game hasn't even launched yet, but I would buy Axie Infinity at a 3 times price to sales ratio with $3 billion of run rate revenue and 100% staking yield. So the idea that we can just blanket say, is a super cycle over, or is it starting, or is the whole market going to go up or down? I mean, these are just stale, outdated terms. And if you're investing in this space and you're talking to anyone who is still using these terms, I would run for the hills. I mean, this is just not what this market is at this point.
And we do know, of course, there are many people. We get many investors and we get many contacts from asset managers and family offices they've looked at the market historically. They've looked back and they've seen these cycles, and they do worry that we're coming to the end of a cycle. So this is what people are coming to us to say, okay, guys, should we invest now? Our concerns are we're coming to the end of the historic cycles. Now, like you, we don't believe that these cycles really carry much weight anymore. It's a completely different market now than 2017. But the question still remains from investors to say, okay, how do you go about ensuring that you lock in profits when markets are extremely bullish or are at record highs? So I guess the question is, how do you as asset managers protect gains along the way or on your investment journey? If we start with you on this one, Jeff.
Sure. I mean, that's sort of the beauty of what this market has become, right? I mean, this is an industry that historically was dominated by quant and algo investing, which, they're constantly trading, billions of dollars a day without really taking a market view or a long-term view. And on the other end of the extreme, you had the early stage venture investors who are buying anything that, starts up, because if you get 2 or 3 winners, you're getting 1,000x or, 10,000x, and it makes up for the rest of your portfolio. But we now have a $3 trillion liquid asset class that there's just very few kind of growth equity or mutual fund type investors who are playing in the middle. But that's really where you can take advantage of these market moves. So if you start to see signs where leverage is starting to build, or the macro environment is deteriorating, like that, it's easy. Then you take a few chips off the table, or you buy some hedges. And same thing, when you're starting to see conditions improve, you might get a little longer from a beta standpoint. But the reality is, you don't necessarily have to think about taking chips off the table from a whole portfolio standpoint, because again, the correlations between these assets have been going down for years. I mean, I look at the correlation of the top 10 digital assets by market cap to each other is about 0.8. When I look at our correlation matrix of our funds at ARCA, we have about a 0.4 correlation of our assets to the rest of our portfolio. That's a huge difference, right? So when you find different assets in the portfolio that behave in different ways, it's not about taking chips off the table at a portfolio level. It's about taking chips off the table at each individual asset level when it no longer has favorable risk reward. So we size everything according to what our upside downside ratio is, what the liquidity is, what an event or a catalyst that we're looking for, and what the ultimate valuation is. If it hits our price target, we'll be a seller. If it gets anywhere near our price target, we'll start to take chips off the table. And similarly, when it goes down in price for no reason, we'll be buyers. So this is really the first asset class in 15 years where active management just blows away any sort of a passive strategy, because you can take advantage of the different types of assets. You can take advantage of the ways tokens accrue. You can take advantage of governance and news flows and changes in economics that make assets more valuable or not. And you can, up and down size your investments as risk reward changes. You're not locked into something forever. So, long-winded way of saying is that we care much more about the individual positions and whether or not they still make sense than we do about trying to time market cycles. I guess the only thing I would add to that would be, from a hedging standpoint, this is the easiest asset class in the history of the world to hedge, because it trades completely uncorrelated on the way up, and then it has incredibly high correlation on the way down, which allows you to use things like Bitcoin or Ethereum puts to hedge out the entire book. So, active management, low correlation book, hedges, cash management. I mean, these are all things that you can do to protect against downside and take advantage of when prices go down, not have to be student body left, student body right.
Very thorough answer, and I expected nothing less. Richard, is anything to add?
Yeah, I think the managing risk on the downside, as Jeff pointed out, for us as a long only fund, is effectively the levers of cash moving to lower risk assets, and as odd as this sounds to someone outside of the space around Bitcoin, for example, and Ethereum puts have been, I guess, our hedging tool of choice, as it's the closest representation to our portfolio. And there's a sophisticated and liquid market that allows us to do that, and we're quite successful through May, where there was a significant drawdown in using those three levers to protect some of the value in the portfolio. I think the other risk people need to keep in mind, and it's a different one for this space, is the asymmetry in the upside of this space is something that's critical to get right as well. And you think about what keeps me awake at night. Downside risk is clearly one of them, but the ability of letting winning assets go too early is also one of the hardest things to manage in this space. I mean, we've held Solana from 22 cents to $250. And obviously we've taken profits along the way and all those sorts of things, but keeping a mindset, keeping an internal function and monitoring process to hold an asset where that sort of asymmetry is available to you as an investor is something that you got to make sure you get right. And one of the risks to managing this space, that you also understand the asymmetry here that's on the upside. Because I mean, that's why we're playing in this space, right? To get the asymmetric returns that it offers that no other asset in the class can offer, no other asset class in the world offers.
Hence the using an expert fund manager rather than trying to do this yourself for many of the audience. Brian, I'll pass it over to you just to add your comments.
Yeah, so just to kind of tag along here, the one thing that I would let investors know that's very different about this market than 2018, frankly, is that we do have the tools to hedge the portfolio. Richard and Jeff both pointed that out. That really wasn't the case in 2018. That market was just developing. The borrow market, the lending market, Options were really mispriced. If you were trying to hedge, you were paying really high volatility in that. So that's different now. We have the ability, and Rich and Jeff said it, and we're the same way, is we can hedge the entire book out with Bitcoin and Ethereum, whether they be futures or options or anything like that. We can hedge the entire book in really a matter of minutes, frankly, which is something we couldn't do during the last cycle, which goes back to my original comment of, do we get a crypto winter? That's probably why I think it's a little more shallow, because we have all these ways to do it. And remember, when we're taking our hedges off, that's buying pressure. So that kind of keeps a little bit of a bid underneath the market. So, I don't know if we get a super cycle or not, but I know that we have the tools to be able to go through it more, just like any other market.
Excellent. I think that leads me nicely to pass over to Danny as I review the questions that are coming in to potentially pose at the end, and let Danny just take over with a few more questions, gentlemen. So Danny, I'll pass over to you to follow up on some areas.
Thank you, Kevin. Thank you, everybody. I mean, you touched some of the questions that I was going to say, but if we go back in history and you cover this is totally different than 2017 and 2018. And this is one of the real benefits of this market. And we established the strategy because we believe in active management, we believe in research, we believe in you guys, in active managers. I mean, of course, the correlation with Bitcoin was 80%, now is lower. So we want to convey to our investors that this is a different market and is managed by real professional and active management. And maybe one of my jobs sometimes is, let me lead to the question, is to translate what is happening in this abstract world into real cases. And Jeff, maybe I go to you with the gamification and the gaming space. I mean, I know you cover Axie Infinity. I know you do. Can you translate why the gamification aspects of the ecosystem is going to be an important vertical? Now we have developed new verticals that we didn't see maybe 2 years ago. Why is this so important, and how would you monetize this?
Well, I mean, there's been a lot of areas where blockchain has had influence, right? It's just a matter of which ones are quickest to become monetizable, right? A lot of the B2B or infrastructure type applications that are being built on blockchain are just those are going to take sometimes 5 to 10 years to build, right? A lot of these games can almost overnight turn into a blockchain based game and start to do the same things they've been doing with their own in-game currencies, but now using a blockchain based asset. So it's a little bit easier to get into gaming, and it's also a huge total addressable market that is, like I said, the most natural fit for a blockchain based asset. Like, I'll give you an example. If you've ever played a game, or you have children who have played a game, you put in a lot of sweat equity.
And
right?
Roblox.
Yeah, I mean, you put in a lot of sweat equity, right? You're putting in a lot of time. If you decide one day to stop playing that game, historically, you walk away with nothing, right? You've had a good experience, but you've walked away with nothing. You've got nothing from the time that was spent. If you've played a sports game and all of a sudden a new version comes out, you basically have to throw away the old version and start over with a new version. What this idea of using NFTs within games and allowing you to basically earn assets or keep assets that you've developed in a game and ultimately sell them or rent them or use them in another game, that's pretty novel. I mean, that just changes the entire industry. So as I said, first and foremost, gamers are a good demographic for digital assets because they're already comfortable being online all day. They are also already used to having in-game assets and skins and things like that. So if all you're doing is changing the mechanism of their ownership rights within the game, it's just a really easy way to onboard billions of people into this market. And that's what we're seeing, right? I mean, again, we mentioned Axie Infinity only because it's the first real commercial successful game where they've gone from almost no users to 2.5 million daily active users and 2.5 billion of run rate revenue. But there's 20, 30 games behind that are coming. And when you have these hit games, whether it's a Roblox or any other game that's had success, they're seeing this play to earn. They're seeing this idea of integration of NFTs, and they already have blockchain developers working on how do we integrate this. And it's easier to get people who are already doing something to enhance their experience than it is to get someone, you know, brand new to try some new experimental technology. So that's why I think it's the fastest place for growth. It's not the only place for growth because it's the most natural user base, the most natural use case of the technology, and in the highest addressable market that's already sitting there online ready to use it.
I can relate totally. When Roblox you pay and you cannot monetize your time or your money. Maybe Brian, if we can translate how important is the NFT space, and you touch bases on the Nike, on the Jordans. You know, sometimes we clients are say, look, this is a crazy space. You pay $60 million for a painting or a digital painting, and it's difficult for us to translate it. How the transformation that is going to be in the space. Can you translate this for plain people and say, look, this is a name change. This is a total new vertical.
Yeah, it's a great question. And to be frank, you know, I'm not sure that I can explain why a digital ape is worth millions of dollars. I just, you know, I've been trying to do it for the last 6 to 8 months and I don't have a satisfactory answer. But here's the thing about it is that it's those speculative and speculators that bring in the new technology. And that's exactly what this asset class needs. And that's why Axie Infinity is really so interesting. And this kind of goes to a lot of Jeff's points, is that you need a quote unquote successful business model to come into play, to use these technologies and these things that have been speculative on, and that speculative money goes into the development of the ecosystem. That's just all part of the growth of the ecosystem. And so, you know, when I think about where NFTs are going to be, I start to think about the infrastructure that you're going to need for it. And, you know, I talked about the Nike, the digital Air Jordans. Well, you're going to want to play these across platforms. So now you need interoperability. So maybe you look at protocols like Polkadot or Cosmos Atoms and stuff like that, because if I buy, you know, a $10,000 pair of Nike Air Jordans that only 2 other people can own, I better be able to wear them in my Solana game and my, you know, on Avalanche and on Polkadot, wherever I want to wear them, I better be able to wear them. So I think, you know, you can bet on, hey, this NFT is going to be crazy and everybody's going to love it, and there's going to be a cartoon series developed around it. Maybe. I'm not an expert in that, but I do know that you can buy kind of the picks and shovels, if you will, of that space that you're going to need for this ecosystem to develop.
Correct. The infrastructure is there, you know, is easy to say. Richard, going into the, you know, the metaverse now and the DeFi space, I mean, we see, of course, NFT gamification and now the metaverse, everything translates together. How do you play this in the DeFi, you know, more infrastructure?
Yeah, I think the metaverse one's an interesting one because it's been a, you know, for those of us on the call old enough to remember, it's been kind of a promised land now for, you know, almost 30 years in terms of, you know, virtual reality and the adoption of effectively, I guess, what used to be known as virtual spaces and now becoming things like the metaverse and the like. So for us, it's been a question of adoption, but also a question of, you know, the ability of hardware to actually serve an experience which is, you know, good enough to attract more than just, I guess, the most devoted of users. And I think we're starting to get to that point now where hardware is caught up and, you know, software development is caught up to starting to create those experiences that actually add value and are interactive enough that allow people to actually create a space they want to spend material amounts of time in. We think we're very early in that. We think the monetization around that is not particularly certain at this point in time as to the exact way to actually play that sort of growth through that space. And, you know, gaming does have parallels to here in terms of, you know, most of the successful games or most of the games coming down the pipes in this space of building that metaverse type experience for users as well. But we do think that this is, you know, like the NFTs and somewhat created and it's interlinked to it, the way in which these two work together. These are the use cases that bring those billions of users to this space because they're creating a completely new experience that builds upon existing human behavior. You know, it adds liveness to things that people have always done. Collecting baseball cards or football cards or whatever it may be has been something that people have done for decades. This technology just adds a more, you know, adds a liveness layer to it that allows people to trade those cards or update those cards or whatever however they may be represented but it's a human behavior that's been around for decades. And this technology just seamlessly adds and effectively an upgrade to that experience. And so it brings those millions of users and adds that utility layer. And they're not using that digital representation of those cards or that NFT version of those cards because it's a, you know, it's a blockchain driven NFT. They're using it because it's a better version of what they've been using for the last 30 or 40 years.
Mm-hmm. This is definitely a time to monetize royalties over time. Maybe one other aspect in the DeFi space is the yield or the fixed income is something that many people are difficult to get a grasp. What is the risk? What is the rewards? How transparent is this? Do we have the right tools to do the yield, the staking? Maybe Jeff, you can touch bases on this. You launch a new fund on the fixed income area. Many people say, what is this yield coming from? Is transparent? Is risky? How can we talk about the space?
Sure. You know, the fixed income market and the cash market is dead and has been for years, right? I mean, it just is. There's nothing left there. You've got what, almost $20 trillion of negative yielding debt. You know, real rates are as low as they've ever been. You know, it is an asset class that, for all intents and purposes, should not have any assets in it anymore, other than the fact that from a legacy structure, there's accounts and funds set up that has to own it. But you talk to any individual and say, you know, do you own any cash and do you own any fixed income right now? There's nobody saying, yes, I can't wait to allocate more to that space right now. So the question is, well, how do you replace that yield? How do you replace that investment? And obviously, there's a lot of different places that investors are stretched. Where the most obvious right now is in the digital asset space, but there's a lot of misconceptions on where that yield is coming from. So to start with, there's basically two reasons yield exists in the digital asset space. One is because this is an incredibly working capital starved industry, right? You basically have two completely separate siloed worlds right now. You have your bank and brokerage traditional pipe system, and you have your digital asset system. It's very hard to get assets between those two worlds right now. Once you're in the digital asset world, it's a very fragmented world, right? It's very much like the corporate bond market. You've got, you know, hundreds of different exchanges and dealers, and you have to have capital at all those different places in order to transact. It's not like you can have a prime broker that holds it all for you and then you transact seamlessly at these different venues. So if you're a market maker and you want to, you know, make a market on 1 million Bitcoin, you basically need 10 million worth of Bitcoin to make that market across 10 different exchanges. So this need for working capital creates a very large SEC lending business where if you are somebody who has cash or has assets or has stable coins, you can lend that out to those who are working capital starved. The second reason yield exists is because most of the growth in digital assets has come from customer bootstrapping through rewards. You are incentivizing people to utilize your platform, whether it's DeFi, whether it's gaming, whether it's Web 3.0, you're giving them inflationary rewards via your native token to use the project. And you know, it's no different than if you start a restaurant and you decide to give free food away for a month. You know, you'll get a lot of people in the door, but eventually your restaurant has to be good. Your food has to be good. The ambience has to be good. The service has to be good to keep those people there, but you'll get them in the door. But these inflationary rewards or these user rewards are therefore driving a lot of yield. You know, you can be an early adopter, an early customer, and be paid for doing so. So those two factors are what generates the yield. It's not all in DeFi. A lot of it is within DeFi. But specifically with DeFi, there's some misconceptions there as well, right? A lot of people are saying, well, DeFi is too risky, I can't invest in it. But you have to understand there's two different types of investing in DeFi. One is just being a passive, you know, quasi-equity-like owner by owning the native token. And one is being an active user where you're actually putting your funds at risk. Right. The analogy would be, you know, if you're afraid of flying because you think planes might crash, you don't have to be a customer of Delta, but you can still acknowledge that others do fly and still buy the stock of Delta if you want to. So if you want to buy a DeFi token as an investment because you believe in the growth of DeFi, you can do that. If you want to be an active user of DeFi because you actually believe that this is a better way to lend and to borrow and to buy insurance and to trade, then you can do that as well. But they're two completely different things, and they're not, you know, they're not mutually exclusive, and they're not, you don't have to do both at the same time. So again, understanding what it is you're actually doing within these DeFi ecosystems is really important. So just, you know, bring it back to ARCA for a second. In our digital assets fund, which is a research-based fund, we're invested in a lot of the tokens of DeFi protocols, but we're not a heavy user. In our digital yield fund, we're not investing in any of the tokens, but we're a heavy user. So two completely different risk reward profiles, two completely different ways to understand and utilize this asset class right now.
Mm-hmm. Richard, would you complement?
Yeah, and I think this is one of the most critical parts about investing in this space, and while we spend a lot of time thinking about it as a fiduciary, there's two aspects, I guess, that we see when we put our portfolio together in digital asset fund. Picking the right assets to own that are the fastest horse in the race, and then making sure that we make the most out of those assets when we own them. So if I look through our portfolio at the moment, we have 13 assets of any size in digital asset fund. We're working those assets or using those assets, 11 of those 13 assets in some capacity, whether it's staking them into a validator that we run to generate the return, or whether it's using them through a governance function again to generate more return and add value to the assets we're holding. And I think, to give you a good example, I guess, of the delta that this can provide, we've been an owner of Terra Luna since around 23 cents, 24 cents back last year. We've held that asset, if someone on the call had bought that asset at the exact same time as us and had held that securely in their wallet, over the first 6 versus how we held the asset and pointed it at one of our validators and then the income and the rewards that we did for holding that asset. If you'd bought it at exactly the same time as us but held it passively versus us buying it and using the asset to generate the income that we can get from being really active around staking and airdrops and rewards and those sorts of things, over the first 6 months of that investment, it was a 600% delta in the change. So it just shows you the capability here to add value through not only picking the right assets, but then using those assets in the right way to generate that yield income. And from our perspective, when we're operating in an asset class that is extremely risky and volatile, it's incumbent on us as a manager to, when we find an asset, to basically squeeze the lemon to get everything possible we get out of that. And some of that is using these assets, utilizing these assets to sort of amplify those returns through those sorts of strategies.
Thank you. I mean, being cautious on time, I wouldn't like to leave with the final question of legislation, how the different jurisdictions are playing and the arbitrage between these jurisdictions, and how the US is positioning itself, and for example, when an ETF, Bitcoin ETF is going to come, we know now in Canada, in the US, in Switzerland, in Germany, in Singapore, jurisdictions are going far than the US. But what is happening? Maybe Brian, you know many people. It's a difficult topic, but legislation is playing an important role with our clients. No?
Yeah, I mean, just from the big picture, you're talking about a global asset that's subject to multiple local legislation, and so the U.S. is probably front of mind for everybody right now because of we just passed an infrastructure bill here, which has some negative pieces to it for crypto, but again, there's another bill going through that may reduce some of that. So there are other countries that are way ahead of the U.S. and I've talked to several people here in the U.S. in the government, and we have some great senators. The senator from Wyoming, where we're located, is doing a fantastic job and really being an advocate, which is something we didn't have 2 or 3 years ago. That being said, it's not going to be an easy climb. So we have a good lobbying base in Washington. We have good representation. But there is, the banking industry is a formidable competitor. A lot of what we're trying to do and what a lot of DeFi is doing is directly disrupting that business. And by all rights, they shouldn't let go of that business. I mean, they worked hard to get it. So, when a competitor comes along, there's a bit of a fight. So we're going through that period. In general, though, I have been more encouraged by what's happened in the US over the last year than I have over the last 4 years or so. There has been a marked change here in the US about how these cryptocurrencies are regulated. And, I've always viewed regulation as any step away from a full ban is just positive news for the space. We'll figure out, it's going to be messy. As they say, that's how the sausage is made. But we will figure it out. And I feel pretty comfortable that we'll get a regulatory environment that you can both be innovative. You can grow companies as well as you can invest in these companies in a regulated way.
Maybe Richard, you from your part of the world in Australia, how do you see it? How do you play? Do you have concerns on the legal framework?
To be honest, I think Brian's kind of hit the nail on the head there by highlighting, you know, the fact that crypto now has a voice in the room. I think from our perspective, when we got to, you know, when we reached market peaks in May, and then the regulatory shocks through China and some of the draconian, I guess, messaging come out of various US regulators and lawmakers, I think that was some of the darkest days from a regulatory perspective for the space, because it just seemed also one-sided. You know, it's all negative. It was all draconian. It had no focus on growth. It was all about regulation and tapering, I guess, the entrepreneurship that we see in this space. I think the key thing that changed over that May-June period was that crypto found its voice, both at a community level, and then that community level voice, and I guess that attraction of the growth that the space can provide and the innovation that can provide, which any sensible government needs to prioritise, particularly as, you know, where we are economically to continue to drive economies. That voice, that local voice, found some support in some pretty senior levels across governments, you know, particularly in the US, but in other jurisdictions as well. And from our perspective, that was a subtle but a very important change, and it basically changed a change in the environment where everyone in the room was anti-crypto. Everyone in the room that's setting regulation, at least, was anti-crypto, to the point where we actually had a more balanced view. And I think, from our perspective, thinking about regulation, there's going to be bumps in the road along the way. We think the returns that the growth of this space generate far outweigh the risks around those sort of short-term bumps with regulatory changes. But the nice thing is now, as those regulatory changes come in, we know they're going to be set with, you know, with at least a view on growth, at least a view on let's not starve the innovation here that's available. And I think from our perspective, that's the best dynamic we could hope for.
Thank you. Kevin, I pass to you to do the final tracks.
Jeff, do you just have any comments to add on that? I just thought, before I jump in with the questions.
Yeah, sure. I think, I mean, look, there's multiple companies and projects that have tens of billions of assets that are trading below book value, or that have billions of dollars of revenue and are trading at, you know, 2 to 4 times price to sales ratios. Like, where do you think these things would trade if we had a real clarity and real regulatory framework where traditional investors could get into this space, right? We have things yielding, you know, 10 to 30% that don't have full participation yet. You know, where do you think this is going if we have full participation? So I would just argue that all of the fears about regulation are more than baked in. You know, you've got trillions of dollars of capital sitting with their feet at the edge of the pool, just waiting for the green light to jump in. You know, that's not an environment that I'm scared of. It's not like we've been trading as if regulation won't happen, and all of a sudden it's going to be coming out of left field, and oh my God, everything's down 50% because of regulation. Like, it's inevitable. It's of course happening. Behind the scenes, the regulators are doing what they're supposed to be doing. They're calling funds, like I'm sure every single person on this panel has had a conversation with the SEC. You know, they've been in our offices for 5 days trying to understand what's going on in this market. They're behind the scenes, they're doing exactly what you'd expect them to do, which is learn about the technology, learn what currently falls under their actual laws and regulations versus which ones need new laws and regulations. But you don't see that on a day-to-day basis. You see the draconian headline, or the the crazy speech from Gensler or something. But you know, it's going to take years to form real laws and regulation that fit this space. In the meantime, it's just political theater and headlines, and that's not something that is terribly concerning to me at this time from an investing standpoint.
I think you're right there. I think everybody alluded to the fact that as and when we see slight positive moves by way of some forms of regulation, we're just going to see more players enter the game. As you said, people are sat waiting to get in, waiting to feel more comfortable because of regulatory perspective. And as it starts to change and mature, we're just going to see more money come into the space. So it can only be a positive in the long term. I've just been looking through the questions there as Danny was going through. We've probably only got room for 3 or 4 questions, and I'll just pick a couple of them here. So the first one, I'm just going to open it to the floor. So whoever wants to take a bite of it, go ahead. First one is, how important is it to be systematically early to new ideas or tokens, i.e. having first mover advantage versus having confidence in the fundamentals of the project? Does this differ in the digital assets versus more mature assets?
I mean, I don't think it's important at all, quite frankly. I mean, I think it's completely two different strategies. If you want to invest in an early stage venture fund and expect to have, 90% of their investments fail, but 10% of them be home runs, like that's a completely different strategy than investing in one of the funds like the three of us have here, where we're investing largely in the secondary market of companies and projects that have product market fit, that have revenues, that have user growth. It's two different things. It's not one is better than the other. They're just different. For example, in our fund, we've had 13 different positions in our fund that have made 50x, and none of them have been early private rounds. They've all been existing secondary tokens that we found because we were using blockchain explorers, we were using publicly available data to see when that product market fit starts to hit, when you see that user growth, when you see that revenue growth, when you see the cash flow start to accrue to the tokens. So I don't think being early is bad. Clearly, if you get them right, it's a home run, but it's not a crucial part of investing in the space, right? The nice thing about the sweet spot that most of us here in active management live in the space is that you don't have to be Peter Thiel and be the first investor in Facebook, but you also don't have to be the retail investor waiting for the IPO. You can come in and out whenever you want because of the liquidity of the asset class and take advantage of publicly available information to make those calls, and not have to wait until a company or project is raising a round or until you get access to a deal. You have carte blanche to do it as you see fit.
Seeing a few nods there. I think we're pretty much in agreement there. Richard, just anything to add?
Yeah, I think you need to be mindful of the the incredible inefficiencies, which brackets equals opportunities that happen in these markets. And we operate both on the venture side and on the liquid side of this market through our two different funds. And you've got to think this is different to an equity market. The listed liquid market here is not as far removed from the venture market as it would be in a typical equity construct in terms of maturity and growth profiles. And we've found, varying points through the sort of the 4 or 5 years that we've been doing this, that there's often points in time where the listed market is actually cheaper than what we're seeing on the venture side. And I think, through sort of September last year, after the market had, after DeFi's kind of pretty aggressive sell-off, that was one of those periods where we were still seeing super strong valuations on the venture side, and we've seen completely depressed value on the listed side. And that point, that's one of the times that we bought Terra Luna at sort of 20, 22, 23 cents, which was basically much more compelling value than anything we were seeing on the venture side of our business. So this market is very inefficient. From my perspective, it's not so much worrying about being early or late, it's being in the right areas where this space can monetize. And I think one of the things that happens is there's some incredibly cool stuff going on around blockchains and around this tech, and some incredibly disruptive ideas, but not all of them are monetizable. And as an investor, our job is to sort of sift through those opportunities and that disruption, and find that disruption that then leads to an investment case, so we can make the returns from an investment, putting our investors' hat on. And if you choose the right sectors, whether it be DeFi, whether it be infrastructure, whether it be NFTs or gaming, if you can choose the right sectors, that's a key part of getting the job done, and finding those places where this technology will be monetized, because that's where the outsized returns will come from.
So I'll jump on the next question. Question here, and I think I might have to reword it a little bit. It says, what happens to traditional, or let's say what happens to large cap digital assets, for example, Bitcoin and Ethereum, if or when central banks launch their own digital assets, which I think is just a matter of time. So when CBDCs are in play, I guess the question would be more around, where do we see, if any, negative impact on any sector of the market? Does anyone want to take a stab at that?
Yeah,
I think one of the things being around this space for a number of years, I've never come across an investor or any person that owns Bitcoin that's ever said to me, I'm just holding Bitcoin until the Fed launches a digital dollar. So I think we need to keep in mind these are two very separate things. Like, no one is buying these assets just as a bridge to a digital central bank dollar. They're extremely different assets, completely different asset classes, and people own them and invest in them for a completely different way. I mean, our view on these digital dollars is what it does is it just increases adoption of digital usage of wallets and those sorts of things, and helps drag what I'd say is the laggards in society into the digital frame, where the assets that we invest in, they become one step closer to the assets that we invest in the bridges and those sorts of things that are being built to to bring them into the crypto world.
So
the
one thing that I would add on that is, I don't think CBDC, central bank digital currencies, are a risk to traditional Bitcoin, Ethereum, those things at all. I think they're a risk to traditional banks. When you think about, if I have a digital dollar, a CBDC in a wallet, and I can send it peer-to-peer, and I can hold it securely, what do I need a bank for? So I'm not worried about Bitcoin. I'm worried about Jamie Dimon. Hope he's all right.
Anything to add, Jeff?
I don't view these as competitive threats. I view everything in the digital asset space right now as being a fight against the status quo. So anything that increases adoption and users ultimately is accretive, meaning, you go back to when you first got your iPhone or your Android device, right? Half the apps that are on your phone right now, you probably never would have said, what I'm missing in my life is these apps. But because once you got into that iOS ecosystem or that Android ecosystem, it was just easy to put these apps on your phone. The same thing is true of blockchain, right? If you come in through an NFT, or you come in through Ethereum or DeFi, or you come in through Bitcoin or a CBDC, ultimately it just means new users into the ecosystem. And once you're in that digital asset world, you're going to start experimenting with other apps. So ultimately, it's going to be more of a positive than any sort of replacement value.
Okay, and I think we'll go with one more question because we're just over the hour. I wasn't going to put any questions on a specific token or a specific digital asset, but this one, given the case with the SEC, I'll touch on it. So the questions come in and says, what effect do you think a resolution to the Ripple versus the SEC case will have not just on XRP, but on the wider crypto market? So I think we'll finish with that one. Any comments?
I mean, I'll start. I know there's a lot of people that own XRP because they think it's going to go up if the SEC, if that is resolved. I don't know. I don't have a dog. I don't have a horse in that race. I'm skeptical when everybody is on one side of the boat. I don't think it'll have, to me, I don't think it'll have that much of an impact on the rest of the market. It seems to me to be somewhat of a Ripple specific. Maybe it gives us some clarity around what is a security, what isn't, but I think we already have clarity there, and there's enough people in the market that have already kind of parsed that out.
Anyone have any comments before we close off?
I would just say, in general, this is just a strange asset class from a representation standpoint. Everybody is now aware of what GameStop and AMC have done, but the equity investors will largely say, "Oh, those are two weird stocks that don't represent the rest of the equity market, but they sure get a lot of media coverage." Well, you get those same two types of assets in digital assets, which is like Ripple and Dogecoin, and people say that must be the entire market because look at these two things, and they're basically the same thing. These are two sideshows that don't really represent the rest of the market, but for some reason they become more symbolic of it or have a lot more media coverage. So there's a lot of assets in the top 20 or 25 by market cap that my fund wouldn't touch. They just don't make any sense to us. It doesn't mean that they can't be exciting for a retail investor, or they can't, that people can't form an opinion on it. But it's you really have to go to the mid caps and even small caps just to form a balanced portfolio or a balanced sector representation of where this asset class has been. So something like Ripple, it's not even on my radar. It's it hasn't been on my radar for 3 years. So I just don't have an opinion no different than I don't really have a strong opinion on GameStop or AMC.
Perfect. Well, gentlemen, I've just had to turn my light on because it's actually getting dark here. It's 4 o'clock in the UK and starting to get dark. Richard, for you, it's whatever o'clock in the morning. So a special thank you for you for attending at this time. Thank you, Brian. Thank you, Jeff. Thank you, Danny. We'll talk again later, Danny. So that concludes really our third and final webinar of the year. We continue to work closely with Brian, with Jeff, with Richard, and on their products. And yeah, we are always open for contact. Should anyone on the webinar wish to reach out to us, please feel free to do so. And yeah, thank you very much, guys. I look forward to catching up with you all as soon as possible. Enjoy the rest of your week, and thank you very much.
Thank you very much. Thank you.
Thanks, everyone. Take care.
Thank you.
Bye-bye.